Lots of drama in Turkey today and a jump for the lira against the greenback because we got another rate hike from the Turkish central bank. And this is being seen as a pretty defiant move considering President Erdogan earlier saying today he wants lower borrowing costs and said as much earlier before the bank took the action it took today. So now the bank's key rate is 24% in a country where inflation is almost at 18%. So here's the pop today, but of course it's been a tough ride for the Turkish economy overall and for its currency in the past 12 months. Let's get some perspective on this and the rest of the global currency market now from Adam Button, Chief Currency Analyst at Forex Live. Good to see you again, Adam.
Nice to be here, Greg.
So let's start there. We got a bit of a reprieve today for the Turkish lira, but obviously not making up barely any of the ground that it lost this year. How does this play out not only for Turkey, but for the other emerging economies? We've had some jitters there.
It's an unbelievable scene. And, for other global central bankers, they're worried about spillover. And if you're in South Africa or Argentina, where it's already spilled over, or even to India, you're very worried about how this is managed. And you don't know if this is about higher U.S. interest rates or if it's about political problems. I mean, you talk about Erdogan signaling that rates are going to come down, and then a couple hours later they hike them more than expected and blow it up. So now you're loggerheads with the central bank and the government. So this is partly a political crisis, but how much of it is an economic crisis that's going to spread elsewhere? And I suggest we watch South Africa right now and then India further down the road. Those are the places that I think are most vulnerable going forward.
Now we know that the emerging markets, both on the currency side but the equity sides, have been a tough place for investors to be in the past couple months. Funds are coming out, and then people think, I guess, when you get back into the North American markets, that we're going to be safe and we're well insulated from this. I mean, it's a lot of degrees, a lot of steps removed. But do we need to worry at all about our North American portfolios when things like this happen in the emerging markets?
Yeah, I think there are some competitive industries where you're going to face those pressures. But there's been a big rethink over the past few years about the currency pass-throughs. And we can see it right here in Canada. You have, say, a 20% discount in some of these places on the currency, and you'd think that would make them so much more competitive. But as we've seen in Canada, we had a 20% discount in our currency, and the manufacturing industry didn't pick up the way the central bank thought it would. And I think there's a lot more safety and a lot more security from those competitive pressures. Now, on the demand side for commodities and that sort of thing, yeah, there's some weakening, but there's also a lot of good news from Europe, from the United States, from parts of the developed world.
All right, the United States, we mentioned the fact that we had a president in Turkey who said one thing, the central bank did another. Now, nowhere near as chaotic or crazy in the States, but we do have a president in the White House who's like, why don't you guys have my back when it comes to cheap money? And you have a U.S. Federal Reserve that's poised to keep tightening. What do you expect out of the Fed on September 26th?
Yeah, the Fed is going to hike twice this year, and it's almost a certainty. The market's about 80% for 2 hikes. It's a slam dunk at the end of this month, and what we need to start thinking about is beyond next year and the terminal rate. And the Fed has talked about coming up to neutral for a long time right now, and they see that around 2.75 or 3%. And the market thinks, well, there'll be a pause after that. But we've had some recent talk from the Fed to indicate, well, there's a short-term neutral and a long-term neutral. And the short-term neutral is higher than the long. So it's a whole new kink in the thinking there, and it might mean U.S. rates go much higher next year, and Canada will probably follow along with that thinking as well. So it could be much more tightness, and that would really hurt emerging markets as well, and you have to start to think about that again, and equities.
Now, if Canada follows along, if the Americans tighten more than we're anticipating, that could have some pretty big ramifications for our economy, because we know that for the past 10 years, when we talked about economic growth, it was in consumers going out and borrowing, whether they're buying cars or whether they're buying houses. These have been big drivers of our economy. We have a lot of debt now. That seems to be a dangerous game for the Bank of Canada to play.
It really is. I mean, Canadians are over-levered. Housing, though, has leveled out. I mean, housing's done a lot better than I thought it would. A lot of people thought it would over the last year or so, with a lot of the new measures to curb borrowing and make it more difficult to borrow. I think there is some insulation there. I think consumers are starting to feel good about job security, about wages, and I think Canada can weather it out, for another 150 basis points of hikes so far. So long as people aren't paying, over 5% on their mortgage, I think most people can continue to spend and expand and borrow, so long as they feel good about the economy, and they should feel good about the economy.
Canadian dollar right now just a little shy of 77 cents U.S. Of course, we're still talking about NAFTA. We don't really have any great signs on that front from day to day. What can we expect out of our currency in the next couple of weeks or months, depending on which way NAFTA goes?
Right. If NAFTA gets done, I think there's considerable upside. So the scenario is that NAFTA gets done, and then America and China go into a trade war. In that scenario, Canada is selling to both sides. I mean, in any kind of war, if you can sell goods to both sides and they are trading with each other, it's ideal. Some Canadian companies can really capitalize, and I think the currency can do well. Now, if NAFTA falls apart, I think there's a lot more downside in the currency than there is upside. But that said, it's a low percentage probability at this point. I mean, Trump seems to be hung up on dairy. I think Canada wants to make some concessions. Right now, it does seem to be at an impasse, but there's very little inside information coming out, and it hasn't blown up yet. So that still suggests a deal can be made. So, good news. Deal gets done. I think you get Canadian dollar easily up to 80 cents over the next couple months. And if it were to fall apart and Canada were to get into the crossfire, you're down, at least to 75 cents, unless Congress can come and save the day on NAFTA.
Right now, the market is pricing in an 87% chance that Stephen Poloz will hike in October at that meeting near the end of the month. But you think they're still heavily NAFTA dependent on this? If they don't have any clarity on NAFTA by then, can he really do that? Yeah,
that's going to be a tough time if we're getting to the end of October, because NAFTA at that point, if it's not done or the signals aren't very positive, I think you've run out of time. I mean, political deadlines are just made to be broken, as we've seen over and over again. So you can push it to a certain extent, but I don't think you can push it out that far. So there is some risk that falls apart, but they can just wait and push it down another month or so, and that's not going to hurt the currency too bad, so long as it resolves well. And of course, the midterms are going to play into that as well.
All right, yeah, the midterms, lots to talk about. Look forward to the next time we have a chat, Adam. Thanks for coming in.
Thanks, Craig.
Adam Button, Chief Currency Analyst at Forex Live.